So from the next step, now, what is the next step is the tax savings on interest cost, right? What will be the tax savings on what? On interest what? On interest costs. On the what? On the interest costs, which is 2. Uh, Tax savings, step 3, savings on interest cost. That is the next step. Princess, princess. Okay, I guess it's a mistake, right? Okay, tax savings on interest cost. So let's check. That is the next step, right? Tax savings. Can you see it? Class, can you see it? Tax savings on what? On interest what? On interest what? On interest costs. You can't see my screen, so it's your network. Please, you can log in and log out. Please confirm. Can you see my screen? Please, others, confirm if you can see my screen, please. Hello? Hello? Please confirm if you can see my screen. Cost, right? Now, that is why I said adjusted present value is very simple. Just understand these tests, and that is the test you will use to solve any question in adjusted present value. Now, tax savings on interest cost. Now, don't forget that you will pay interest on 2 loans. Is that also class? Uh, Class, you will pay interest on what? On 2 loans, which is the the cheap loan as well as the what? The commercial debt, right? They say tax savings on what? Tax savings on interest cost. The cheap loan as well as the what? The commercial. Now, between these two, now you will decide that, oh, you want to go for commercial, whether you want to go for commercial loan or you want to go for there is commercial debt, there is cheap loan. Is that also? Now, from the first one is cheap loan, right? The cheap loan rate is, what is the cheap loan rate? Sorry. The cheap loan rate is 3%. 3%. So 3% times, right? So what is the gross amount? The total cost of borrowing. Where is it? Where is the cheap loan? Sorry. Where is the cheap loan? Okay. Is it? Where is the cheap loan? Cheap loan, cheap loan, cheap loan, cheap loan. Where is it? Where is it?
300.
Okay, okay, okay. Okay, okay, okay. That's fine. So tax savings on what? On interest costs, right? And from the beginning of this question, we said there is issue cost. Is that also issue cost on commercial debt, right? And issue cost on what? On equity. So on cheap loan is 300. Is that also cheap loan is 300 million. Now don't forget that it is tax savings. So multiply by tax, which is 30%. So what do we have? Class. Give me figure. What do we have here? Figure.
2.7 million.
Okay. One what? 2 point.
2.7.
Okay, 2.7. 2.7. So the next is commercial. Don't forget, there are two loans, right? It is interest, commercial, right? Commercial is 5%. I know some of you will make this mistake. Times the commercial 5% times what? 5% times what?
1.5 million.
One. Hello. The interest will be on what now? Class. The cheap loan is this, which is 300. Is that not so? So the commercial debt now, the commercial debt will be now be on, the interest will now be on what? Will be on
151.51.
oh, Olanike. Well done. So the commercial debt, just meet your mind. Okay, the commercial debt will be on 151.515. So you can ask your question, oh, if you have question here. 30%, right? So what do we have? Figure
2.27.
2.27. We are using 3 decimal. We use 0.455. So we should use 2.27. Call the total figure. What do you have? From that figure,
2.273.
call all the figure that you have. Call it
2.273.
2.27. Do you have, wait, I'm coming. Have you approximated it?
Yes.
Okay, just give me the full figure. What is the full figure? 2 point what?
2.272725.
Okay. 2.272725, Abi?
Yes.
Okay. I can have this as 3. Now, you can ask your question. Oh, so what is the total amount? Add these two together. Add this together. Add this together. What do you have? Give me a figure.
4.93. 4.973.
4.973 million. Someone should ask, why do we use, ask question now, please. So
why did you apply the commercial on the
gross amount?
yes?
Thank you. That is a very good question. I say ask question now, please. Just ask anyhow question. Just ask it. Don't worry. I will answer you. Right? Don't forget. I'm coming. I will answer that question. Don't forget that the tax is in arrears. Right? Class, the tax is in arrears. Now, year 1 will be paid in year 2. Year 2 will be paid in year 3. Year 3 will be paid in year 4. And don't forget, this project is for 3 years. So therefore, we can have from year 2, sorry, since it is arrears, year 2 to 4, because the tax is in arrears. That is what we will plot on in this table. That is what we will plot here. We will plot it here. Right? That is what we will plot it here. Okay. Then before I answer that question, okay. Moses, I'm coming. So why do we have to apply it? That is a very good question. Because cheap loan did not have issue cost. I didn't mean because there is no issue cost. There is no issue cost on cheap loan. We would have used the gross amount, the total cost of the debt. We would have used it, class. We would have used it. But cheap loan, subsidized loan, does not have issue cost. We don't have the gross amount. The only gross amount we have is 300 million. Now, they say interest cost, the commercial debt, we have the issue cost, we have the gross amount of the total cost of it. So we charge the interest on the total cost, right? So that is why we have to do it that way. Do you understand?
Yes, sir.
Okay. Moses.
Yes, sir. Sir, please, when examiner is silent as whether the issue cost is going to suffer tax or not, what do we do? Do we assume the issue cost is with tax or?
I've explained that one at when we were treating tax savings on issue cost. I guess you are just joining us, so that's why.
Oh, sorry, sir.
I've actually explained all those parts.
Like you said, I joined late. Sorry, sir.
No, it's fine. It's fine. So when it is like that, when the examiner is silent about the issue cost, the tax savings on issue costs, right? You use the commercial debt. Just use the commercial debt issue cost, and you can state your assumption at the end. It is assumed that the issue cost will be on the commercial debt at year 1. Simple. It is allowed, right? Then when the examiner is saying that, says that the tax savings will be on all the debts, right? The examiner will still not tell you that this particular project is only financed by debt. So when it is only financed by debt, it means both the commercial debt as well as what the subsidized debt will suffer the tax savings on issue costs. We'll get there. That is the next question. We'll get there, right? So I hope you understand that, Moses.
It's okay, sir. Thank you very much.
Okay, you're welcome. So now, if this is established, class, I hope we are getting it. If this is established, we move to the next step. Understand this step. Oh, you must understand it. See, I don't want to know how you want to do. Either you cram it or you anyhow. You understand the step, you move on. The next step is savings on interest saved, or savings on interest, or interest saved. Let me use I need to change this word. Let's say interest was interest saved, right? Let me use that. Or savings on interest. Just use I'm just see, you can't see this format. I can tell you, and like I can see it anywhere. The way they will present it, it will look somehow. That is why I say use your own language, right? You can use interest saved, you can use tax savings, or you can use interest saved. You just use interest saved instead of saved savings interest. Just use interest saved will be fine. So now step 4, interest saved. Interest saved. Madam Linda, are you still in this class? I need to confirm. Okay, she's not. Okay. Interest saved, class. The question now is, did they actually save any interest? Yes. The question is yes. Because there is a commercial rate of 5%. There is a subsidized loan or a cheap loan of 3%. Class, how many percent did I save? Therefore, you can now say 5% minus 3%, you close brackets, times the commercial debt is 5%. You want to know, you quickly go and take cheap loan. How many percent did you save? That is the interest saved, class. So what did you save? You save it on what? On the 300 million of the cheap loan, class. Let me quickly take you back to the financing. Can you see it? The cheap loan is 3%. The commercial loan is what? How many percent did you save for you to say you want to go for the cheap loan, how many percent did you save? You saved 2%, right? Is this 2% of the amount that you save? Is 2% of the 300 million, because that is the cheap loan. That is what you save. Class, are we still together, please? So that is why I say, oh, the 5% minus the 3%, how much did you save? It's 300 what? What is the what? You save it on what? It's on the cheap loan. You save it. That is what you did, right? Now, what is the figure? Figure,
6
please.
million.
Okay, 6
million.
million. 6 million. So interest saved. So this will be from where? From which year to which year? Who can tell me? Interest saved. From which year to which year? Hello? Year what? Year 2, Abi? Year 2
Year
to
1.
4. Who said year 1? Who said year 1?
Yet to 4.
Okay, you said favor. Okay. 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 It's from year 1 to year 3. Do you know why? Because there is no tax savings on this. Do you do tax savings? You say interest saved, and the project will last for 3 years. It is only on tax you do 2 to 4. Please always take note of that, right? Just take notes, please. So year 1 to 3. Class, from our table. After that, from our table, we have tax paid on interest saved. Of course, relevant tax authority will say, you have saved, bro. Come and give us. Don't forget, from your income statement, after you remove your interest, you pay tax. Is that not so? Come and give us. Maybe you save. It will be cash inflow to you now. Maybe you save. Come and give us money from what you save. So, and that is what? The tax paid on interest. So SFM is interesting. You can see that adjusted present value is very simple. Lastly is tax paid on interest saved. Right? Oh, you've saved money. That will be added to your cash flow, right? Don't worry. Come and give us money. So you pay to the relevant tax authority. So we have tax paid on interest what? Interest saved. Right? So 30%. What is the amount saved? The amount saved is what? 6 million, right? Class. You can see the amount saved is 6 million. So we can have 6 million. So what do we have? What do we have? Quickly. Figure.
1.8.
1.8 million. Oga Favor, you dey use bedroom voice for me. Okay, oh. Favor. They play. So this is tax, right? So year 2 to year 4. Oga Samson, are you still in this class?
I full ground, sir.
You full ground, they play.
My head they pound, so I just respect myself quiet.
That's fine. It is expected though. Right, it is expected.
Yes, sir. Thank you,
So
sir.
once you go through it again, you get it. So we'll solve
Sure,
that's
sir.
why I said we'll solve 3 questions. So this is the first question, so we still have 2 questions. So by the time we solve the second question, we get familiar with all these jargons here, right? So
Yes, sir.
it's nothing. Yeah. Thank you. So we are done. Oh. The only thing you need to do is that just plot it in this table. Plot, and you get your PV or financing effect. We are done with this class. You can see it is very simple. We'll just pick the figure from year 0, year 1, year 2 to 4, year 1 to 3, and what? 2 to 4. So let's quickly do that. right? Okay. Now, I said, yeah, let me quickly say this again. PV of financing effect. Use the pre-tax cost of what? Of debt of the main company to discount. That is what you will use. You cannot use the commercial debt. It is the debt of the company, the cost of debt of the company. That is what you will use because it is financing effect. Class. You use what? You use the cost of debt of the main company. The cost of the, this is the financing effect. What we use to finance the business. What will be the cost? So that is what you will use to discount this project. So issue cost at year 0. So you give me figure. Just quickly screenshot this. Screenshot this part so that we can move. Let me see. Are you still
I'm here.
just? Okay. Please screenshot.
Yes.
Olanike and there's one name I want to call, but I'm scared to call the name.
Where do you want me to screenshot? Is it this page?
Yes.
Sir, don't worry. Call the name.
No, so that you not sue me. Just okay. Let me call the name Edibo, right?
I'll actually have to drag you to court, I swear.
Okay. Please, can you call the name so that, please, because I will continue to call this name till we finish SFM. Okay.
Now, the name is Edibo, not Edibo. But that's
Okay.
actually my surname anyway. My own name is Eleojo. Not
Eliojo.
Edibo.
Okay, Eliojo. Okay.
Thank you.
Okay.
Child, you dey laugh me like this now. You know good though.
Who will be that favor? I think Eliojo. Okay, Eliojo. Okay. By the time I call it for like 3 to 5 times before we finish it, I think.
I've been now.
Well done. Okay. Let's quickly move on. Okay. Issue costs. So now we use the law. We use the cost of debt of the cost of debt. That is pre-tax cost of debt. So what is the pre-tax cost of debt of this main company, class? Cost of debt. What is the pre-tax cost of debt of this company? Pre-tax cost of debt?
5%.
5%. Okay, that's fine. So in this case, we can use this place as, we can put it as 5%, right? So the issue cost. So please give me figure for the issue cost, for the cash flow. So I have to use, I have to put million. Sorry, hold on. Okay. Million. So okay, just hold on. Let me arrange this. Okay, so what is the issue cost? What is the issue cost on equity?
4.63.
The issue cost on equity.
This is it. So you see, issue cost on commercial 1 point, or should I copy it? This is the issue cost. Give me the issue cost of this. issue cost to issue cost. Screenshot it, please. So issue cost on equity. What is the issue cost on equity? Sorry, equity first. You can switch it anyhow. So what is the issue cost on equity?
4.639.
4.639. So this will be at year 0. This will be 1. So 4.639. Then what is the issue cost on debt? Issue cost on
1.515.
1.515. So what is the DC? Okay, 1. Sorry. So this will still have 1.515. Okay. So what is our tax savings? Tax savings. So on commercial, that is the next from year 1, right? What is the tax savings? Quickly. Okay. I'll scroll up, don't worry. Tax savings on issue cost commercial.
2.273.
Don't worry. Let me scroll. Commercial. Let me write it. Okay. Let me scroll up. Can you see it? So this is a tax savings on commercial debt. Can you see it? 0.455. Can you see it? Okay. 0. What? Is an inflow. 0.455. So what is the DCF for year 1? What is the DCF for year 1? What is the DCF?
943. 943. I think I made a mistake. Sorry.
0.954.
0.95 what? 4, right?
No, 0.9524. Sorry.
0.952.
Okay. 0.952. Okay. So when you multiply, what do you have? Please, if you don't know how to calculate the DCF, I beg, please tell me. Just unmute your mic. Unmute your mic. I will show you how to calculate the DCF. Please. So what do you have?
0.332.
12
Okay.
points.
0.433.
0.433. Okay.
33.
Please confirm. So what is the next step? Let's check. So after year 0, we have tax savings on interest costs. Tax savings on interest costs 4.973, right? From year what, self? From year 2 to year 4. Okay, I need to check this. 2 to year 4. From year 2 to year 4, tax savings on interest costs. So if you want to check it, you can go. So what is the figure? Sorry, give me the figure again.
4.973.
4.973. So I hope we know how to do this. Okay, let's quickly do it again. I think we did that in our previous lecture. 2 to 4. We've done it. Can you see it? This is the 2 to 4. First, you do 1 to 4. Class, you do 1 to 4. Oh, this is wrong now. Because the DCF will change. Is that not so? The DCF will change. Let me copy this. Control Z. Let me copy this and so we adjust it here. Class, are we still together? Who is against us in this class? Please, if you are against us in this class, let me know. Unmute your mic. So, don't forget, the DCF, the R is 5%, 0.05. Class, we want to look for year 2 to year 4. Is that not so? Then when you want to look for year 2 to year 4, you come year 2 to year 4, you need to get your DCF from year 1 to year 4. When you get your year 1 to year 4, you just remove only 1 year. Is that not so? You remove 1 year. And the R here is the DCF, which is 0.05. So we change this to 0.05. So year 1 to 4, what do you have? Year 1 to 4. Year 1 to 4 class.
3.54.
6.
3.546.
46.
So give me the DCF for year 1. This is 0.005. So what is the DCF for year 1? I think we've done it. 0.952, right?
Yes.
So 0.952. Right? So when you remove it, you remove year 1. Class, this is year 1 to 4. Then you remove year 1. When you remove year 1, you have year 2 to 4. So when you remove it, what do you have? Subtract it. Subtract.
2.594.
Eh?
2.594.
2.594.
94.
Okay. $2.594. Good. Okay. So when you multiply, what do you have?
12.900.
Okay. 12 point what?
900.
Okay, 900. Okay. So the next one is interest saved. So we go up.
So please, can I ask a question?
Okay, wait, let me finish this. Okay, let me just finish this. So interest saved, you can see interest saved is what? 6 million from year 1 to year 3. From year 1 to year 3. Year 1 to year 3 is 6 million. Right? So what will be the annuity? Calculate the annuity from year 1 to year 3. Do we still have anyone who does not know how to, who did not know how to calculate annuity? Annuity this year 1 to year 3. If you don't know, this is the formula here for annuity. This is the formula for annuity. So you just get it, right? This is the formula for annuity. And the numbers of years you are looking for. Oh, okay, it's from year 1 to. Wait. I think there's a mistake. Is there no mistake here? The numbers of years is what? Okay. That's fine. It's okay. Okay. So, and this is from year 1 to year 3. Just do your annuity raised to power minus 3. Right? So what do you have?
2.723.
Please confirm 2.723. So what do you have when you multiply?
16.338.
338. Okay. The next is what? What's the next? What's the next thing? Is interest what? Interest paid. Can you see it? Interest paid is from tax paid on interest, sorry. Year 2 to 4. That is 1.8 million. 1.8 million, right? Coming 1.8 million. From year 2 to 4. 1.8. So it's from year 2 to 4. We've done it before. We just do copy and paste here. Then what do we have here? Figure.
$4.669.
Okay. 4.669. Okay, what is the PV of financing effect? Is it positive or negative? So you can unmute your mic if you have the question. Who is that? Someone says. Okay, please unmute your mic. You
Okay,
have
sir.
question?
I wanted to ask that this one that we did in year one for tax saving on interest cost, we did it was actually year 2 to 4, which is 3 years, but we did from year 1 to year 4. If
Yes.
we do from year 2 to 4, that's like if we do for just 3 years, we did not give the same answer.
No. It won't.
So to give something different.
Yes. You can try it. So it just, the best is do year 1 to 4. Remove year 1. Then, but you can try it if it gives you, fine. But I've not tried that method, but I know it will not, it may not give you. Let me just say it. Let me just say, okay, it may not give you.
It did not. Okay.
Yeah.
Thank you.
You're welcome. Okay, is it positive, exclusive? Is it positive or negative?
So this tax paid, is it not an outflow? Okay, sorry, it's outflow.
Ah, exclusive. Oh. Too much Gary. Okay, what do you have?
90 million.
18 point. Okay, it has been submitted. No, I got 18.848. 848 positive.
84. Is it 848?
Yes, 848.
Okay, it's 18.848. Okay, please confirm again if we have 18.84. Okay, who is that? Let me see.
Yes. Yes. The area I don't understand is the area of when you were calculating the interest of year 2 to 4, you are minusing year 1 from it. I think even from the last class, I'm still trying to get it.
Okay. Can you say we want to get year 2 to 4?
Okay.
Right. So first thing you need to do is that get your year 1 to 4. You know, when you get year 1 to 4, right? Because it is 2 to 4, get year 1 to 4. Then what you need from this year 1 to 4 is just 2 to 4. Is that not so? Then remove year 1. When you remove 1, you have from year 2 to 4. That is why we have to do it this way. If it is year 4 to 10, do year 1 to 10. Right? You know, it is year 4 to 10, right? Do year 1 to 10. Then you now remove year 1 to 3. If you remove year 1 to 3, you are left with what? The 4 to 10. Do you understand?
Okay. So do you mean year 1 to 4 is 3.546 and year 1 is 2.94? Sorry, year 1 is 0.95. So you now negate it from 3.546. You go to okay.
Yes, you get.
Okay.
Can you see it? So this is 2 to 4. right?
Okay.
So you can, when you look at it, this is annuity. Is this annuity formula you will use to get your year 1 to 4? And this is it. It is annuity formula is at the back of your question paper. If you want to use it, fine.
Okay. All right. Thank you. I'm okay.
Yeah. Okay. So, any other question, please? So now, all these the base case NPV and the PV of finance. Don't forget that it's just these two variables we're looking for. The base case NPV and the PV of finance. And we have to go through this all this calculation. And we are looking for just these two, these two, right? Is that not so? It's just these two. So I can copy this. Base case NPV. What is our base case NPV? We calculated it in our previous class, right? So the base case NPV, take note, is minus 19.62. 19.62, right? I say 19. Is it 19? Okay, 19. Is it 19? Oh, God.
It's 9. It's 9.
Oh,
9.6.
okay. Thank you. So APV, your base case MPV, so is a million, right? So we can put the million here. Oh, coming. So what is the base case MPV? 9 point what?
9.62 negative.
Okay, 62 negative. So why we have here 18.848. So what is the difference now? Because we have negative there, so we need to subtract. So what do you have?
9.228.
Okay, 9.228. Okay, so it is positive, right? So what is your recommendation? Recommendation. Sorry, come. So recommendation. The project is viable, right? The APV is positive. The project is considered viable, right? You can use viable. Okay. So that's all. Right? Just this base case MPV. But we just have to go through this route. If you have question, mute your mic. Mute your mic.
That calculation that DCF that we did, that we had to subtract the previous year from the year that is needed, is just applicable to issue cost, right?
Which one? I didn't understand. I didn't get your question.
The one we did, year 2 to, no, that was year 2 to 4.
Okay, yes, it's only applicable. This is it. It's only applicable when there is tax, because in the question it was stated first, establish that how did they pay this tax? Is it in arrears or it is being paid in that year? If it is being paid in that year, you don't need to do 2 to 4 because it is not in arrears. It is only when the tax is being paid in arrears, that is when you will now say, oh, year 1 will be paid in 2, 2 will be paid in 3, 3 will be paid in 4. That is why we say 2 to 4. Do you get?
Yes. Okay, so if it's on the actual year basis, then it has to be
from year 1 to 3. Because if they pay the tax in the year at which the profits arise. Fine. It will be from year 1 to 3. Don't forget, your issue cost will always be at your year 1. So any other thing from that will now be based on the tax.
Okay.
But establish that. How did they pay this tax? Is it in arrears or tax is being paid in the year at which the profit is being made?
Okay. Thank you, sir.
You're welcome. So, any other question? Question, please. So you can see adjusted present value. That's all about this question. I'll send it immediately after this class for those who have paid for the material. Send it. So I have 2 questions here. These questions are examinable questions. Can you see it? And okay, they are examinable questions. This is 40 marks. Okay, let me remove this one.